Good afternoon, everybody, and welcome to Chapter 9 of Accounting 205. This will be our first video for Chapter 9, and we're going to start off talking about withholding methods. All right, the Bible of payroll accounting for federal tax purposes is called Publication 15. And if you're going to be involved in payroll at all, I would download this document and keep it as a PDF file on your computer. The Publication 15, otherwise known as Circular E, is what all businesses would use that don't use a payroll service to calculate their payrolls every pay period with. Okay, so let's take a look at page 9-2, 9-3, 9-4, and 9-5. The withholding methods, there are two of them. All right, one of them is the percentage method, and the other one is the wage bracket method. Now, both of these methods can be found in Schedule C of your book. Okay, so I'll give you a second to get there. All right, again, this is an Appendix C at the back of your book. Okay, all right. If you take a look on pages C2 and C3, they will show you the percentage tax tables for withholding for calendar year 2017. You can compute anybody's paycheck, no matter how small or how large, using these tables. Okay, they also have wage bracket method tables, and those are found on page C4 and C5, C6, and C7. And the only ones you see there are for the monthly pay period. Okay, but the wage bracket method has its limitations. For example, if you go to the bottom of page C5, at the very bottom, it says that if the wages are $5,080 and over for a single person at a monthly payroll period, and that's not really a lot of money, okay, then you have to use Table 4A, and they're referring to Table 4A on page C-2. All right, so in other words, the wage bracket tables are only good up to a certain point, and then you have to use the percentage method tables for anybody that makes a higher wage than that. Okay, so if you're doing a payroll, all right, how do you know what to withhold? All right, well, first thing you do is you compute the person's gross wages. All right, if they're on salary, they're going to be paid the same amount every week, you know, assuming there's nothing unusual going on. And if they're, you know, on wages, you will take the amount of hours that they worked per week up to 40 and take that amount of hours times their hourly payroll period, and that's their gross pay. Or if they're, according to the Fair Labor Standards Act, there are only two provisions that are guaranteed under federal law. One of them is the minimum wage, which was $7.25 an hour, and the other one is time and a half for hours worked over 40 hours in a calendar week. There are some exceptions, for example, for nurses and hospital workers and things like that. And those are the only two provisions. All right. Any other provisions would be found in other laws like OSHA, or not found at all. All right. For example, you know, there's, you know, it's a common idea that everybody gets a lunch hour at work. Well, there is no provision for a lunch hour in the Fair Labor Standards Act. Okay, it's just that, you know, a common practice has led to the idea of having a half hour or an hour lunch hour if you work an 8-hour week, but there is no legal provision for that. Okay, so how do you know how to do somebody's paycheck? All right, well, the first thing you're concerned with is federal income tax. All right, and that federal income tax and the amount to withhold is determined by Form W-4, which is replicated in your book on pages 9.3 and 9.4. All right, how the employee fills that out will determine the amount of wages that will be taxed and the amount of income tax that will be withheld. Okay, so even with the new Tax Cuts and Jobs Act, the employee still has to fill out a W-4 for 2018. All right, now the one in your book is for 2017. There is a new one out there at the IRS website for 2018. The W-4 mainly is based on the exemption amount. Now, there will not be any exemptions on the 2018 federal tax return. Okay, that has been done away with. All right, and they've increased the standard deduction for single people to $12,000, for head of household to $18,000, and for married filing joint and qualifying widower to $24,000. Married filing separate would be the same as single at $12,000. All right, so when you are figuring out the employee's paycheck, you first figure out their gross pay, as we first mentioned a few minutes ago. Okay, and then you look at their W-4 and you see how many allowances that they claimed in box 5 or line 5 on the W-4. So they give you an example of Tom Berry, all right, on page 9.3, and Tom is claiming 8 allowances. Okay, that's what it's called. It's called an allowance. All right, on the 2017 tax returns and before, they were called exemptions. All right, but on the payroll, it's called an allowance. Okay, so if you take a look at page 9-5, okay, we can take a look there. All right, and when you look at page 9-5, you see that if you are being paid weekly, you get an allowance of $77.90 per allowance. If you're being paid bi-weekly, it's doubled to $155.80 per allowance. All right, one allowance equals one exemption. All right, you can tell that real easily by looking at the annual amount. The annual amount is $4,050, which is the same as the exemption would have been on the 2017 tax return. So when you're first computing somebody's federal income tax liability, what you do is you take the number of allowances that they had on their W-4 times the allowance amount that you see in the middle of page 9.5. Okay, and then you subtract that total from their gross wages. Okay, then what you will do is you will go to Appendix C, okay, and you will take a look at the tables on page C2 and C3. So let's see at the example that's on page 9.5. Okay, they said in the middle of the, down towards the middle of the page, it says Sharon is married, her pay is $22.50 per month. So that's her pay frequency. She gets paid monthly. On her W-4, she claims married and 2. Okay, that's the way they call it, married and 2 allowances. Okay, so if you look at the table in the middle of page 9.5, it says for monthly, all right, she has an allowance of $337.50. That means that you take that amount times the amount of the allowances on her W-4, and that equals $675. What that means is that every month, no matter what Sharon makes, she will not be taxed on the first $675 that she makes. Okay, so now what we do is we go to page C2, all right, and Sharon is married, so we're going to go to table 4B, all right. Sharon makes $22.50 a month, all right. So what you do is you take a look at the table, and it says if she is over $721 but not over $22.75 after subtracting the withholding allowances, okay, then you would take her net amount times 10%, which is what they did on 9.5. They took her pay of $22.50. They subtracted the $675 in withholding allowances, That gave her a withholding income of $1,575. Then they compared that number to table 4B. All right, that number falls into the 10% line. That means that Sharon's in the 10% bracket. All right, so they take 1575 minus 721, because if you make under 721 a month, you don't have any taxes taken out at all. And her federal income tax for the period is $85.40. Okay, now Sharon is in the quote-quote 10% bracket, because that's the bracket it shows, all right, on page C2. All right, all the federal income tax brackets are again shown in these tables. So if you go to page C2 and you look at table 4B, you'll see there are the brackets: 10, 15, 25, 28, 33, 35, and 39.6. So Sharon is in the 10% bracket. Okay. Now, I got to caution you about something here, because I get this question a lot when people fill out W-4s. All right, remember, it's a inverse relationship here between the amount of tax withheld and the amount of the allowances. The more allowances you claim, the less taxes you have withheld. All right, now we said that Sharon was in the 10% bracket, and this is what I see a lot with my clients who end up owing on their tax return. Okay, Sharon had gross wages of $2,250 per month. All right, if she was really at the top of the 10% bracket, she would have 10% of that, or $225, withheld from her paycheck. Sharon only has $85.40 withheld. All right, so there's a possibility that Sharon may owe at the end of the year, or get a small refund. Okay, all right. Now, it doesn't say why Sharon is claiming two allowances. She could be claiming one for herself and one for her husband or partner. She could be claiming it because she has another job. There's a lot of different things. All right, but most of the people that I meet, and they'll ask me, well, Rob, what do I have to claim in order not to owe at the end of the year? And I just tell them, you can just claim single and zero. If you claim single and zero, you will never owe on your tax return at the end of the year, because you're going to be paying out a lot of federal income tax during the year. Now, what if you're married? All right, what if you're married? There is a box, and if you look on page 9.3, you'll see that box. There's a box that says married but withhold at the higher single rate. That means I'm married, but treat me as a single person for federal income tax withholding purposes. Okay, so in wrapping up this small section on withholding methods, okay, you can use both of either the percentage method or the wage bracket method. All right, but the percentage method is the one that, again, most computers will use. All right, and the wage bracket method, of course, has its limitations because it only goes up to a certain gross amount. Okay, that's the end of this video, and the next one we'll pick up with pension income.